Hello, and welcome back to the Asset Allocator podcast, which you can now watch and listen to. I'm Aamina Zafar, funds reporter at AA. Joining me today is David Thorpe, our very own contributing editor. Welcome, David.
Hello, Aamina.
Also in the studio is Henry Cobbe, head of research at Elston Consulting. Hello, Henry. Thank you for joining us.
Thank you for having me.
In today's episode, we'll explore how investors should think about resilience, income, and opportunity at a time when markets are sending quite mixed signals. So how should investors be positioned for what comes next? Let's delve into it. So, Henry, as you're aware, bond and equity markets have been telling two very different stories. Bonds have been quite volatile, whereas equities actually have continued to rally. In this environment, how should investors think about their asset allocation?
Well, it's certainly been an interesting year, and I think we can all getting a bit slightly immune to shocks. So if you think about April 25, we had the tariff shock and how that upended predominantly equity markets and bond markets, again, in different ways. And then this year we've had the US-Iran conflict, which again has impacted equity markets and bond markets in a different way. And I think what's been interesting, as you point out, is that the equity markets seem to now be looking past this and looking forward and sort of taking a bit of a speed bump, whereas the bond markets are, again, slightly more also looking forward, but slightly more agitated. And I think that's because of the different risk factors in play. So if we think about the equity markets, they are very much focused on that earnings resilience and the kind of AI theme, if you like, which is this kind of productivity step change that's happening in the equity markets. And I think that despite all the doom and gloom on geopolitics, investors are really looking past that into what does this mean for corporate earnings? What does this mean for earnings growth? And as the earnings growth drives the majority of the US market, the US market drives global markets, it ends up being a kind of tech US global is a chain of growth, if you like. In the bond market, it's a slightly different story, whereby it's been a complete, I don't know how to pronounce the word volte-face. How do you say, like when it's a seed, an about turn? What's the right word?
Volte-face.
Volte-face? Okay, volte-face. Okay, most of my inner Italian trying to come out. It's been a complete about turn, because at the start of the year, bond yields looked quite attractive, and bond real yields looked attractive, and inflation was moderating. And so suddenly it looked like bonds were back, having had a very kind of patchy 21, 22, when you had the rising interest rates, rising inflation. Bonds were like a slightly kind of leave-alone asset class, but suddenly they're beginning to get their mojo back, and real yields are positive, and bonds looked exciting as of December, January. And then we had Iran. And with Iran, it means that we've had this energy disruption, far bigger in a way than was the case with Russia, Ukraine. And the IAA are on record as saying it's the largest supply shock in history in terms of energy. And what that means is effectively, depending on how long the Strait of Hormuz remains shut, which we don't know, and will change every little bit of news, flip-flops every day between whether marginally could be longer, marginally could be shorter, depending on the politics of it. But every day that remains shut is a greater outage of the kind of bedrock of economy, which is energy. And if that remains shutter for longer, I know that's not English, but we'll go there, then inflation remains stickier for longer. And therefore, interest rates, which we thought were going to be coming down this year, have had to completely reprice, whereby now the expectations is to bias towards rate hikes as opposed to rate cuts. And that obviously changes the outlook for bonds, it changes the outlook for equities. And I think we're in a position where we've got kind of resilient equities and soggy bonds. And that means you do have to have a rethink of the overall asset allocation. And we can come back to the nuance of the equity market later, but the overall thing that people need to think about is it time to reinvent or rethink the 60-40 portfolio? And we think it is. And we're concerned that the 60 bit, that's okay. That's equities. And obviously there's nuances around that. We can map it out. But the 40 bit's become a real problem. The 40 bit was all bonds in the old days, because bonds are seen as defensive diversifiers. But our concern is in a high inflation regime, bonds have become soggy and they've kind of lost they neither provide defensiveness nor they provide diversification.
And in that environment, is it the case that you because when we say bonds and we talk about bonds as a diversifier or volatility dampener,
in the good old days,
we really mean government bonds when we use that in the good old days.
Yeah.
But what about the corporate bond market?
Okay.
Because yields in investment grade are perhaps 7%, and long-term capital market assumption returns for equities are only 8%. So, is there a case for being there or high yield? And yes, high yield spreads are tight, but I've done maybe 100 episodes of this podcast, and every one of them we talk about high yield spreads are tight, but they stay tight. Is there a case for going out there? Do they have a role alongside the equities? Is it, you said bonds are soggy, is it dry?
Government, yeah. So government bonds are soggy. So our big concern is around government bonds, both in the US and the UK, owing to the level of government indebtedness, which we call debt indigestion, where people just literally can't digest the amount of debt being issued, and the fact that they are nominal assets. Nominal assets means a bit like a pound note. They've got a face value, and the longer in time that face value is to run when inflation is running, the less value it has in real terms. So the devaluation of real value of bonds is a big problem when inflation expectations are on the rise. So when I'm referring to soggy bonds, I should say to soggy government bonds. As regards the rest of the bonds complex, corporate bonds are marginally more attractive than government bonds. But again, if inflation is the worry, no matter, I don't think yields are necessarily as high as 7%, but if inflation there's a worry, it's about the term. And so short-dated corporate bonds for yield, yes, as long as you think there's going to be no recession, which is what the equity market's saying. Because if there's a recession, that's when you get spreads blowing out, that can go the other way. But short-term corporate bonds are more interesting than government bonds. If corporates have got more cash to finance themselves than governments have, then yes, I'd prefer short-dated corporates over short-dated government bonds for that reason. So if you think of the investment grade issuers, they're often in a better long-term financial trajectory than governments are, the development market governments are. We also like emerging market dollar and emerging market local bonds within the bond complex. So if you think, first of all, let's have a bigger question. Let's come back to a bigger discussion about to what extent do bonds still make sense in a 60-40 portfolio. But to the extent that it does have bonds, we very much think avoid government bonds. And we were actually, made our name in a way, recommending our investment manager and financial advisor clients to deallocate entirely from bonds back in late 2021, ahead of the shock, because of the study of what's happened in the 1970s when interest rates and inflation ticks up. And again, we recommended to all our investment manager, financial advisor clients to get out of gilts in the summer last year, because we were worried about the sustainability of long-term UK finances. So, ironically, we were then lured back in December, January, when inflation was heading towards 2%. And then when the moment the war kicked off, we're back straight out of gilts entirely in terms of our recommendations. So we kind of would love to love government bonds, but we can't find the love there. So let's come back to the 60-40 thing a bit later. But if one is having any bond allocation in the portfolio, we think you're right, David, it's about short-dated corporates, where they're in better cash position and better financial strength position than governments, and EM dollar, EM local, because we think, ironically, emerging markets and developed markets they've all done a clothes swap. Developed market governments like UK, France, America, they are over indebted and questions about how they actually fund themselves, whereas emerging markets like China, India are in an ever better position and look much more financially competent in terms of their debt. So we like those. And high yield is one of the ones where it's interesting to look at, but it's got its own sectoral biases that one has to be conscious of too.
Coming up later on Asset Allocator, we'll explore inflation outlook and income portfolios. Join us after this quick message.
Opportunity is everywhere. Access is everything. Access is expertise, guiding you with local insight. Access is discipline within a diversified approach, from traditional asset classes to ETFs and alternatives. Access is connection across a global footprint. Because when the world of opportunity is truly in reach, access is everything.
Welcome back to Asset Allocator. So, Henry, how important is the inflation outlook in terms of driving up portfolio returns in the next year or so?
Well, inflation is one of those key, what we call macro factors. So if you think about all the news items we get, and obviously we're in a news building here, and there's every little bit of snippet of news comes up on the wires and comes through the press and comes through the newspapers. But actually, if one thinks about the main macro drivers to portfolios, it comes down to growth, inflation, and interest rates. Those are the three, what we call macro factors. So whatever news story you read, you think, what does that mean for growth? Or what does that mean for inflation? Or what does that mean for interest rates? So because inflation is one of those, the big three macro factors, it's absolutely critical because it does two things. One, in the bond market, it's an essential metric because it determines to what extent the face value of the bond you're getting the coupons and principal back on is actually worth anything in real terms. In the equity market, it also has a big impact but more from a factor perspective, and I'll explain what I mean. So in the bond market, if you think that traditionally, like when I were a lad, as it were, so when we started in the city back in the late 90s, early noughties, when you did your textbooks, you'd say, well, roughly speaking, inflation targets around 2%, real yields around 3%, so nominal yields around 5%. That was the kind of good old days as a normal world. Then post-financial crisis, we had the kind of interest rate suppression to kind of quantitative easing, print money and get yields down to make sure that the whole system didn't fall over. And suddenly in a position where real yields were if nominal yields were 1%, inflation expectations were 2 or 3%, or 2%, let's say. So your real yield was minus 1%. And in that era, in the 08, 10, 12, 15, etc., people going, what's the role for bonds now? They've got a negative real yield. Where do we find yield? And people go around looking for more exotic asset class, going, oh, look at this gives you a 5% yield. And I think in the old days, 5% was risk-free. Now 5%, you've got to sweat it to find 5% yield. So nominal real yields were negative. And when we had the first inflation shock in 21, 22, real yields went structurally negative to such an extent that a government bond was a promise that you were guaranteed to lose money in real terms. You were guaranteed to lose money in real terms. And so that's when we got very, very anxious about the large holding of government bonds because so many investment managers and financial advisors rely on risk profiling tools which set long-term asset allocation that may have no relevance to the current market environment. And although things are in the long run mean reverting, in the short run you can get really slapped around in the face. People were blindly buying bonds and blindly allocating to bonds, even though there was a foreseeable harm event. Interest rates could only go up. They were at 0.1% heading north. Inflation was on the rise post-COVID when the restart. And when you looked at the real yield figures of minus 3% 10-year real yield, it was a government-backed guarantee that you would lose money. And yet people bought them anyway. And so we saw static allocation strategies, what I call dumb portfolios, which usually work in the very long run. They work fine on a multi-year view or 30-year view. But for going into those choppy waters, it was very clear that bonds were actually a hazard. And I'd argue they're becoming a bit of a hazard once again. So we're worried about that for bonds, and inflation is important to bonds because it is the main driver of, when you see a bond yield, it's a nominal yield, it's a headline yield. One has to deduct the inflation expectation to find out what the real yield is. And when inflation outlook is stable, the difference between nominal and real yields is also stable. But when the inflation outlook is volatile, then what you're seeing in terms of nominal and real yields can vary very quickly. So when we saw the run-up in inflation expectations, we saw the run-up in gilt yields too, because effectively what the mean is real yields are staying the same. But the way they're expressed in nominal terms has to move to keep pace. So in the bond market, I think inflation is a major driver because it is the most important driver, especially for longer-term bonds. If you think inflation has a bit of an impact over 1, 2, 3 years, has a massive impact if that compounds out for 10 or 20 or 30 years. So inflation is absolutely a key driver in the bond market because it is the hidden boost or drag to whether those yields are real or not, and to what extent they come through in real terms.
And Henry, to what extent, from an asset allocation point of view, maybe this is less relevant to the bond bit and more to the equity bit, but to what extent does it matter what type of inflation it is as well as the quantum? So obviously you can have inflation come in from the demand side and everybody's partying and that's great, or you can have it coming from the supply side, which is kind of what an energy shock does, what happened in the 70s. If we're getting a supply side inflationary shock, yes, that's negative for bonds, but How does that change how you think about equities alongside that?
Okay, so first of all, I think it's an excellent point, and it's actually almost it's a theoretical point with practical considerations. So I totally agree that a supply side inflation push, an energy shock, there's not much central banks can do about this. They can try and contain the damage, but it's not like a policy lever saying, "Oh, run economies." When you go to the Bank of England Museum, if you've got kids, I recommend you bring them to the Bank of England Museum. You can play the monetary policy rate setting game. It hasn't caught on outside of the Bank of England, I don't think, but you can actually go and pull these different levers of economy's going a bit too hot, apply a little brakes. If economy's running too cool, apply some accelerator. So policy rates is like an implementation of in normal times of a kind of monetary policy to temper the growth rate up or down, and to try and get this perfect equilibrium. And in normal times, that's great. But then you have a supply shock that's equivalent to someone coming up and kicking the ball game over with a big boot and saying, now pick that up, deal with that. And actually, no matter what you do with interest rates, it's not going to change anything. What happens, the only to deal with a supply shock inflation is by, in this case, getting the Strait of Hormuz open, or getting gas flowing again, or getting oil flowing again. That's what mitigates the supply shock. Nothing to do with what central banks can or can't do. So in a way, it's a central bank policy response to something that either oil men or generals have to solve. And I think that's the problem that we've seen in the 2022 crisis. And now this is like a policy response in a way, but it's trying to contain it, containing a shock. But the only way to really contain a shock is to achieve a normalization of trade or a normalization of supply.
So, Henry, if investors want to seek income now, how should they think about their portfolio construction?
It's an interesting question, because normal times, income is bonds with the bedrock of income, and in a way they're the things that are income generative. Equally, equities are the other source of income, so dividend income. So, and then most people in a kind of balanced portfolio might go for a balance of each, and multi-asset income strategies or balanced income strategies would be a mixture of bond income and equity income. So, in a way, that's the easy answer. Mm-hmm. But I think in these times, one also needs to think about risk. Mm. And my problem with a lot of what the kind of risk profile industry does is they've made the word risk synonymous with volatility. Mm. So if you want a low risk income, you point towards bonds. If you want a high risk income, you point towards equity. Now that's because the word risk has wrongly been linked solely to the term volatility. Mm. Now, if we say, well, first of all, let's define risk and then let's re-answer the question. So if we define risk as volatility, then the lowest form of lowest risk form of income is money markets. Mm. And then you're effectively tracking SONIA, which is the wholesale rate that's very close to what the Bank of England sets as a target.
SONIA is the rate that replaced the latent unlamented LIBOR.
Yes, the latent unlamented. Exactly. So that way, frankly, that's a better deal than fixed term deposits in my view, because you're just getting whatever the wholesale rate is in the market without having to get it clocked on the bank machine in the banking system. If you want to have a bit more income return, then you go out in maturities. Then you look at 5-year gilts. And if you want a bit longer, then you go out to longer term. But when you start getting term risk in inflationary times, that becomes a problem. So if we define risk not as volatility, but in terms of inflation, let's say the risk is inflation, then on no account should you have cash. On no account should you have money markets. On no account should you have gilts, because inflation destroys their face value. But where you should have is equity income, because the dividends are linked to the profits. Profits are linked to sales, and sales are linked to passing on the effects of inflation. So you think about the pint of Guinness or a bar of soap, those companies are able to push through price increases and preserve profitability, ideally, and then therefore preserve dividend increases over and above or in line with inflation. So ironically, if one thinks about inflation, and also the capital value is generating an income stream, and the capital value of the share price, although it fluctuates, is generally trending higher on a total return basis. So if inflation equals volatility, if risk equals volatility, money markets are great. Equity income is more volatile. But if risk equals inflation, then we absolutely think equity income is the way to go over fixed income. Because fixed income, think about the capital value, although it's guaranteed in nominal terms, i.e. £100 at the end of maturity, it's not guaranteed in real terms. And so that £100 in 30 years' time could actually be totally devalued. Whereas with equities, there's no capital guarantee. Companies could go bust. You've got no idea what they're going to do. But in aggregate, overall, the whole UK equity market, in the long run, is going to still exist. And actually, in the long run, its capital value should outpace inflation, even though the capital value isn't guaranteed. So I think in inflationary times, there's a bit of a crossover. There's a bit of a zigzag whereby what feels safe in normal times is bonds, and equities feel risky. But in inflation times, I'd argue it's actually the other way around. Equities are the safe asset, and bonds are the high risk asset, and that's a complete headspin for, in a way, the whole risk profiling tradition, the risk profiling questionnaires, the risk profiling asset allocation framework. But I'd argue that it's not the regulator who's setting those questions; it's the questionnaire providers, because regulators are asking advisor firms and investment managers to think, when you're talking about risk, what is the risk to client outcomes? So, and the risk of client outcomes of going into nominal assets, i.e. cash and gilts, in a high inflation environment, that's a negative to risk to client outcomes. And therefore, you'd argue that equity income, which is, yes, it's more volatile, but in the long run, it beats inflation. That could be construed as a safer asset when risk is the inflation, when not volatility.
And Henry, within the...
That's a bit radical. But
within the equity complex, one of the challenges that income fund managers or income allocators have had in recent years has been that the equities that pay an income have radically underperformed the equities that don't. So the US market's not an income market, that's outperformed. Within the US market, the tech stocks that don't pay much of a dividend have outperformed. Yeah. And that's created a challenge for advisors because they're running it for income, but their client sees, well, the index returned this and you only returned this and you didn't do a very good job. But they're not trying to do a job of matching the index. But that's been a conversation. So how do you think about the balance for an income client between some capital appreciation and a yield that's worth having?
Okay, it's harder for an income, but overall for any client, and also for an income client, so first of all, income, I think in all the academic studies, it's the underpin of total returns for equity market. It help, particularly in the UK. And in the UK, the majority of total returns are from income, reinvested dividends, not from capital appreciation. The US, it's more from capital appreciation rather than reinvested dividends, but it's still reinvested dividends have a role to play. But I think you're absolutely right. The challenge has been, when you look at global equity markets, the US equity markets over the long term, really since the financial crisis, owning the US/global, which are statistically behave the same way because one is such a large part of the other, has been a sure thing. Whereas the UK has been the also-ran, slightly kind of more pedestrian cousin. Now, that's not to say you have to choose between one or the other. And actually, one of the things you alluded to, which I think is the strong point, is that their difference is their strength. So a bit like potato, if the US market is about growth and tech and total returns, and the UK market is about value and income and defensive companies, more traditional industrial companies, miners, banks, pharma, etc., putting them together, you get some correlation. You get the benefits of decorrelation. So we've noticed that in times when the US market is doing very well, the US market can be doing quite badly. And times when the US has a bit of a shakeout, the UK market proves resilient. So look at 2022. US markets were down 9 or 10% for the year, as were global markets. They move in lockstep. The UK was up 5%. Mm-hmm. It went completely opposite direction. And if you look month by month, often they're directionally, one is going zig and the other's going zag. And as you all know from all the financial theory, if you combine two uncorrelated assets, you get the only free lunch in financial markets, which is risk-based diversification, where the risk of the risk of the combined can be less than the sum of its parts. And so we like UK equities, not because we like the UK economy, we think the UK economy is on the list, we like UK large cap equities, particularly UK equity income, because of these are global companies with a value tilt and a yield factor bias that have a low correlation to US equities. So we like including them, we like pairing them with US equities as a way of creating risk-based diversification, balancing one against the other. So their difference is their strength, If that could be a slogan for someone, maybe.
So we're likely heading into a wave of AI IPOs. I just wanted to get your views on that. How do you see that? Do you think that's a sign that the cycle is peaking, or perhaps the start of the next big investment opportunity?
So what I'm not going to say is this time it's different, because that's the words that get you into real trouble. So I think, look, there's this huge structural technology shift that's going on. And we've seen it, it's one of many. So you had it with the canals, then you had it with printing press, canals, railways, then internet first, telecoms, electrification. So it's a massive, massive industrial change that changed the way all of us live in the world and the way companies operate in the world. And if harnessed well, it should unlock huge productivity for companies, but also potential huge seismic social questions for populations. And we don't know the answer yet. But it doesn't necessarily mean that the IPO that's coming are the top of the market. That isn't necessarily the case. But what it does mean is that there is huge excitement at this structural trend, and the equity market is looking past all the worries that we know about, i.e. fragmentation of a geopolitical order, deglobalization, rising conflict, geopolitical rivalry between the US and China. The market's looking past all that to think this is a structural change that's going to fundamentally change the profitability of corporations. And therefore, if earnings growth can be delivered with improved productivity and with the same or less headcount, you get more earnings for less headcount, this is what AI is going to do. And there'll be winners and losers, and there's a whole different game of who are the winners and who are the losers. But I think the fact that these companies are coming to market doesn't necessarily mean it's the top. What it means is that there is huge appetite and interest in for investors to harness and benefit from this massive structural change.
Sadly, that's all we have time for this week. But thank you very much for your comments, both Henry and David. And thank you to our audience for tuning in. Be sure to join us next week for the Asset Allocator podcast, which is released every Thursday in both video and audio format. You can also log on to our website, ftadvisor.com/asset-allocator. Until the next time, goodbye.